This is FRM Part I, Book 3, Financial Markets and Products, and the chapter on exchanges, OTC derivatives, DPCs, and SPVs. Boy, those are a lot of letters in that chapter title. Hopefully we'll figure out what those mean and what those implications are. But let me just remind you about our conversations in recent chapters. You know, we've talked about futures contracts and option contracts and swap contracts, and we've tried to figure out their values and how to determine their prices and what are the factors that influence the change in values over time. We talked about risk and all that kind of good stuff. And that really was not totally from an academic standpoint. I mean, there were lots of practical implications, but we were trying to figure out, you know, how should these things work kind of in theory? Well, in this chapter, we're going right to the heart of the practicality of it. You know, how do these derivative securities mechanically exist? In other words, how do you start it? How do you go into the middle? And then how do you end it? And which parties are involved? And of course, the answer to that question is that if every participant in this derivative market had tons and tons of collateral and was willing to put up that collateral, then these markets would work smoothly. But if we're going to deal with, let's say, you know, $10 billion worth of notional principal in a swap contract, who has $10 billion to put up as collateral? No offense to your personal wealth, but I, of course, don't have that. So what we need is we need things like, hey, margins, we need to worry about clearing, and we need to worry about a bunch of other stuff. So that's really what this chapter is going to tell us. And this is what the learning objectives, specifically, they're going to say something like, tell me about the exchanges and tell me about the over-the-counter markets. How do we alleviate counterparty risk? How do we clear? And what are the classes here? So we'll go ahead and cover all these learning objectives. We don't have too many slides in this chapter. Let's start with a discussion on how these organized exchanges alleviate or mitigate or reduce or sometimes even eliminate counterparty risk. So remember, an organized exchange is a central trading place, a central financial location where these traders can trade standardized financial instruments. Remember in the last chapter, I emphasized to you how important the distinction was between a forward contract and a futures contract. I mean, they pretty much do the same thing, but a futures contract is a standardized forward contract that's traded somewhere. In this case, it's going to be on a standardized, an organized exchange, and then later on we'll talk about an over-the-counter market. Now, remember that in a previous video, I talked about my calculator here, and you and I could agree to trade this financial calculator. We could do it with a forward contract or a futures contract. But one of the big risks occurs at the maturity date of the contract. Suppose we agree to trade this calculator for $100 in a month. And then in a month's time, the price of these calculators has fallen to $5. And the price is way down at $5, so you have to come and pay me that $100. Well, you may decide to not show up at my door. This is counterparty risk. You know, essentially when you're dealing with contracts, you have two kinds of risk. You know, you've got default risk and you have interest rate risk. And then good old financial practitioners and academics have divided those two risks into tons and tons of different kinds. And so we call this counterparty risk specifically in the derivatives market because essentially what you're doing is trading with another party. You and I are trading this futures contract on the financial calculator. And so that's the risk that one of us is not going to show up on the maturity date with either the calculator or the capital. So think about these organized exchanges. What they do is they want to put in mechanisms that will substantially reduce this counterparty risk so that I don't ever have to worry about you showing up to pay me my $100, and you don't have to worry about, I don't have to worry about you showing up without your $100. All right, so I did mention this in the objective. So what are we doing? There has to be some clearing, right? We have to have somebody or some mechanism under which the contract gets fulfilled. We call that clearing. And then, of course, there's margins. The organized exchanges are famous for requiring margins and then having those contracts valued every day so that there is a daily settlement. So there's a winner and a loser at the end of every trading day. Those of you who watched my old videos will note that multiple times I always refer to that great movie, Trading Places, where Dan Aykroyd and Eddie Murphy, they do a whole bunch of fun stuff. But nevertheless, at the end of that day, those contracts were all settled. That's how they were able to make all of that money. And then, of course, if I owe you $3 and you owe me $5, it doesn't make any sense for us to get together and exchange, $3 and $5. So we'll net the contracts. And then at the end, what we can do is that we can just take an offsetting contract, right? Remember that only about 2%, maybe 1.5% of all derivative contracts are ever settled with the delivery of the underlying asset. And so what the exchanges do is they make it really, really easy for us to cash settle. And so we just take an offsetting position. Let's do a little bit of a history lesson here and try to figure out exactly how these organized exchanges have evolved in terms of managing this counterparty risk. Now remember, in Chicago, this exchange started in 1848, so that's a really, really long time ago. And remember, in 1848, people probably didn't have their smartphones around so that they could just hit a button and the party was identified and then the transaction was cleared. And so essentially what happened was that under this direct clearing method, that one party would settle with the original party. So the original two counterparties would then settle. But you can see how problematic this is. If you and I are trying to settle and I'm in Pennsylvania and you're in Alaska, how are we going to do that? Now, of course, we can meet in Chicago and do this. And of course, we're not going to drive to Chicago. We're going to have a representative meet in Chicago. But nevertheless, the direct clearing, it works, but it's not nearly as efficient as some of these other ones. After some time, then the exchange developed these clearing rings, and this relies on the notion of fungibility. There's one of those cool words. Fungible means that there's just kind of regular substitutes, and people are willing to accept one item for another item, right? And so I have a little bit of a flow chart here. So look on the left-hand side, if party A owes party B under the direct clearing, then A has to find B, right? And then if B owes party C, then B has to find C, right? So under the direct clearing, you'd have it going that way, then you'd have it going that way. But with these rings, what you can do is you can eliminate B. A could just pay C, and that's what I have over on the right-hand side of the arrow. And it really kind of just wipes out the ring. It eliminates the ring. And so even though it doesn't completely eliminate counterparty risk, what it does is that it reduces it because the flow of capital goes through fewer and fewer parties. Now, of course, in this example that I have, A and B and C will have to agree that A settling with C is exactly like A settling with B and B settling with C. There's that notion of fungibility. Now, of course, that's not perfect, and so what we have is complete clearing, and we do this with the central counterparty. So there's this clearinghouse corporation or this organization that works in the middle and writes separate contracts. And so that's what I have on the right-hand side of the arrow. What will happen is that A is dealing with B, and A is dealing with C, and B is dealing with C. So what A is going to do is write a contract with the central counterparty. B will write a contract with the central counterparty, and then C will write a contract with the central counterparty as well. And so this clearinghouse, so to speak, is kind of the middle person who takes both sides and manages both sides. So A doesn't really need to know who C is, right? B doesn't really need to know who C is. Of course, what was my example from a few minutes ago? I'm in Pennsylvania, you're in Alaska. We really don't care where each other is, as long as that clearinghouse corporation or that central counterparty has enough capital, right? I mean, that's important, has enough capital to make sure that these transactions go through. And so that central counterparty is really, I mean, it's a key element. It's the key element in terms of reducing or even eliminating counterparty risk. And so notice that what I have in the circle point there, it may be either operated by the exchange or provided to the exchange as a service by an independent company. All right, so that was all this trading on an organized exchange, but how about over-the-counter trading? And so here's the cool thing. If we go back to the exchange, just look on that far right flow chart. You have A and B and C, and plus you got a bunch of other letters, and you go all the way out to lots and lots of letters, and you have, maybe a couple of clearinghouses in there. And so you have, let me just pick a number, thousands of these traders, and, so millions of these trades are going on. But they're happening at a central location. And so the individuals and the firms, they have to be there. And so it's a lot easier to keep track of stuff. So the standardization helps. Of course, it's more regulated. And so there are more rules and laws and bylaws for the traders to follow. But when we go to the over-the-counter market, remember, the over-the-counter market gets its name from the old days when if you were to have bought a Pacific Railroad Company bond in when did the railroads begin? 1840, 1880, whenever. You would have gone to your bank, and your bank would have slid this payment booklet, a coupon booklet, over the counter at the bank. And so the over-the-counter market used to be really an over-the-counter market. That's really where the name came from. But nowadays, of course, over-the-counter markets, they just exist in the cloud and online and wherever else they exist. But the cool thing about that is that they're probably going to be less regulated, and they can design contracts that meet the needs of all of their clients. Remember, the organized exchanges are for those investors, those institutional clients who demand liquidity and who demand standardization. But not everybody demands that kind of stuff. Sometimes I might need a credit default swap for $1.7563 billion, and I want to have it on that company over there and that company over there and this company. So I bundle those three, and I want to do it not over the standard tenor of 5 years, but I want to do it for 6.5 years or something, whatever it is. So the over-the-counter market can design and tailor these contracts so that they don't have to be standardized. And the important thing is that they can have longer maturities. They don't have to, but they can. Now, note the circle point there. Prior to 2007, largest market for derivative, it was largely unregulated. And so what tended to happen was that what a trader would have to do is probably try to figure out who that original counterparty was, and then work his or her way back to that original counterparty to unwind the transaction. And a lot of times when you want to unwind a transaction, the markets have moved against you, and so there's probably going to be unfavorable terms, right? This is called leverage, that other trader has leverage, and so they're going to say, oh, I'd be happy to let you out of the contract, but of course you're going to have to pay for it. All right, the big concern here is not so much a default from one counterparty to another, because this happens all the time, right? I mean, people decide not to pay. They may be unwilling. They may be unable. But the idea here is that let's suppose that we've got this gigantic financial institution that has tons and tons of this counterparty risk. And if it moves against that particular financial institution and that institution fails, then that's going to have a chain reaction. Back in my doctoral student days, we called this contagion. So that if one bank failed, that it was contagious, so that, oh my gosh, that bank might fail, this bank might fail. Nowadays, I think the politicians have taken over this word, systemic risk. You hear them talk about that regularly. All right, so how do we do this in the over-the-counter market to try to manage this risk and prevent these financial institutions that are considered too big to fail? How do we help prevent them from failing, or how do we help prevent them from starting on the pathway to financial distress or bankruptcy? All right, a couple of ways that we can do this. Let's talk about special purpose vehicles. These are really cool animals. These are their own entity, right? Sometimes people call them special purpose entities. So a financial institution can create this special purpose vehicle, and its name suggests exactly what its function is. It's created and designed for a special purpose, like trading credit default swaps. A special purpose vehicle is never created to invest in a well-diversified portfolio. It's going to have a special purpose. All right. Now, what this means is that this special purpose vehicle has its own balance sheet. And what the parent company does is it supplies a bunch of capital and puts some assets in there for a variety of reasons. This happens during mergers or asset sales or trading of derivative contracts. So special purpose is like a general term. The special purpose could be almost anything. Now, what this means then is that this special purpose vehicle, what did I say earlier? Trading credit default swaps. And so what are we going to do? We're going to write these credit default swaps. And so what happens when you write a credit default swap? People throw money at you. So they say something like, look, I'll pay you $1 million a year for 5 years if when this particular bond fails, when this particular bond defaults, you have to pay the principal. And by the way, I own, let's say, $50 million in these bonds. So we're getting these $1 million payments for several years. So what are we doing? We're generating cash. So there's lots and lots of cash coming in to this special purpose vehicle that I created, specially to write credit default swaps, right? Now, the only time I'm going to have a cash outflow is if that company defaults on its bond issue. So what we can do in this special purpose vehicle is we can say, you know what, we're only going to write credit default swaps on bonds that have investment grades, which means they're very, very unlikely to do so. Now, of course, we can expand into the speculative grade market, but instead of, what did I say, $1 million a year for 5 years, maybe I'm going to charge $5 million a year or $12 million a year. I mean, whatever it is, the price of that credit default swap depends on the probability of that issuing company or that issuing entity from failing. So you see how this works then. So the parent company then puts some good capital in there, and then the special purpose vehicle has the capacity to generate some extra income, which means that it's probably going to be well financed, right? Now, notice what this means is that this special purpose vehicle then has its own separate and unique counterparty risk. It doesn't matter what's happening with the parent company, that if the parent company fails, the special purpose vehicle counterparties are still protected because it's a separate entity. And so notice the bottom point there I have. It transfers counterparty risk into legal risk. That should make sense. Now, back in, maybe the 1990s or whenever this was, some financial engineers had this idea that let's create a special purpose vehicle that is designed to deal in derivative products. So that's what these DPCs are. These are, let me go back here. Remember what I said about special purpose vehicles. They could be for any reason that you could possibly imagine that you need a separate finance vehicle for. What did I say? Mergers and acquisitions, or to sell some assets, or with derivatives, or any other kind of a capital structure thing that you want. All right. So, but these DPCs are specific to derivative products. And swinging back to my example with the credit default swaps, if we're writing all these credit default swaps, this is going to be a DPC. What happens is that the parent creates this DPC and puts enough capital into this entity so that it's going to get a AAA rating. regardless of what the rating of the parent bank is, right? So it's a separate entity, right? Separate entity, so it has a AAA rating. Then, if the DPC is generating all of this cash flow by writing credit default swaps, then it's going to continue to solidify its AAA rating. Now, of course, this sounds wonderful, right? The counterparty risk is eliminated. Doesn't matter what happens to the parent, doesn't matter what happens to the DPC. But of course, what happens during a time period of financial crisis? We spent several chapters a while ago talking about that crisis of 2007 and 2008. And so think about this. The DPC enters financial distress, right? And so it's in danger of losing its AAA credit rating, so it picks up the phone and calls the parent and say, help, help. Meanwhile, the parent is having its own struggles because we're in this financial crisis. And so if there are funds that are drained off, it's not helping the parent, it's not helping anybody. And so this goes back to that whole thing about correlations. You know, we hold these well-diversified portfolios and all these different asset classes that have low correlations, but what do we know? We know that during times of financial distress, those correlations, they move towards one. So that diversification doesn't help you when you most need it. And so the same thing has gone on here. And I imagine there are some of these that are still around, but not many. About a monoline insurance company. So mono, what does that mean? One, and typically means that this insurance company is going to do just one thing. And what they're going to do is typically going to insure a bond. And so this company over here issues a bond, and this monoline insurer comes in and says, oh yeah, I'll help you. If you can't pay the par value of the bonds at maturity in 20 years or 30 years, or 100 years, if it's that Walt Disney bond that was issued 20 years ago or so, then I'll go ahead and pay that principal. You know, so what does the monoline insurance company do? They get payments from the company, the issuer. They get these payments. And boy, they only have to pay out if that ever defaults. That's why they're called a credit wrap. However, lots of these companies failed in 2007, so that's what happened to the monoline insurance. How about a credit product derivative company? This is a special purpose vehicle, special purpose entity that sells credit protection under credit default swaps or some other kinds of credit protection. Now, of course, they're highly levered. And these entities did not post any margin. And then, I think these started, if my memory serves me correctly, they started sometime in the 90s, maybe even the early 2000s. So their life really wasn't that long. And somewhere in 2007, I have 2008 there, it might even have been 2009, these ratings agencies like Moody's, they just stopped rating them. How about clearing in the OTC derivative market? And so these OTC transactions, they're still negotiated privately and off of exchange, but then they can be novated into a CCP on a post-trade basis, right? So these central counterparties then can get involved. And novated, that's one of those legal terms that pops up every once in a while in financial terminology. It just means like that you think there's a good substitute or a perfect substitute. But some firms, they clear and settle repurchase agreements and plain vanilla interest rate swaps and these energy derivatives, right? So there is clearing, and it's a kind of a combination of lots of different clearing. All right, next up we'll do some mechanics of central clearing.